Welcome back to the deep dive. I want you to picture the inside of your refrigerator for a second. Somewhere in the door, probably buried behind some hot sauce, there's almost certainly a bottle of Heinz ketchup.
Or that blue box in the pantry.
Right, the Kraft mac and cheese, these aren't just groceries, they're, cultural artifacts. But the massive machine behind them, Kraft Heinz, has been having a legitimate identity crisis.
Crisis might even be putting it mildly. It's been a really turbulent ride for them.
Exactly. And today, February 11th, 2026, feels like a real line in the sand. We just got the Q4 2025 earnings, and more importantly, a strategic update that reads less like a corporate report and more like a confession.
Right. The headline isn't just the numbers.
No, and spoiler alert, the numbers aren't great. The real headline is that they are completely scrapping the plan to split the company up.
It's a massive U-turn. Just 6 months ago, the whole narrative was break it apart to unlock value. Now, the new CEO, Steve K. Lane, is saying, no, we're keeping it together and we're going to fix it.
And that is what we are unpacking today. We've got the earnings call transcript, the slide deck, the whole package. Our mission is to figure out why this guy, who's only been in the CEO chair for 6 weeks, thinks he can save a struggling giant with a $600 million check and something called Power Mac.
It's a bold gamble, a really bold gamble, especially when you look at the hand he's been dealt.
Okay, let's start right there. The state of the plate, so to speak. Give us the damage report for 2025, because this doesn't look like a company that's just having a bad quarter.
No, it looks like a company that's shrinking, and that's the reality. If you look at Q4, organic net sales were down 4.2%.
Wow.
They missed revenue expectations, came in at $6.35 billion against an expected $6.38 billion. And look, a $30 million miss might sound like a rounding error for a company this size, but the market hates it.
Because it confirms the pattern, right? I saw this is the 4th straight quarter of volume declines.
That's the scary part. It's not just that they're making less money. People are physically buying fewer Kraft products. They're leaving them on the shelf.
So they're losing customers.
Exactly. And while they did technically beat earnings per share estimates, 67 cents versus 61 expected, the adjusted EPS for the whole year was down 15%. But that revenue miss, that's the signal. It tells us their pricing power has just evaporated. For years, big food companies could just raise prices to cover inflation, and we'd all grumble but pay it. That's over.
The inflation shield is gone.
Completely. And the decline was driven primarily by market share losses right here in U.S. retail, their own backyard.
Okay, so who are the problem children here? Who's dragging the class average down?
Well, they called out a few specific culprits. Lunchables, spoonables, which is basically, yogurts and dressings, and their frozen meals. These categories just hit a wall.
Lunchables is interesting. That feels like a bellwether. If parents are swapping that out for something cheaper or healthier, that's a huge shift.
It is. But there was another term you probably saw, inventory deloading.
Ah, yes. That sounds like corporate speak for nobody wants this stuff anymore.
It's a polite way of saying that retailers, your Walmarts, your Krogers, they're terrified of holding the bag. With interest rates this high, keeping extra Velveeta in the back room is expensive.
So they're just ordering less.
Way less. They're running lean. So if Kraft Heinz sneezes, the retailer catches a cold and just stops ordering.
And speaking of catching a cold, what was that specific issue in Indonesia? A distributor in financial distress?
Yeah, that was a local crisis with a global impact. A major distributor there basically went under, and it tanked their results in that region by double digits.
So shrinking sales, nervous retailers, international fires. The Wall Street playbook says break it up, split the company.
That was the plan. The classic good co, bad co strategy.
Spin off the cool, high-growth global brands and leave the boring North American grocery business to fend for itself.
Right. But today, Kyle Lane killed that idea. He paused all separation work.
So is this just cold feet, or is he admitting the bad co is just too sick to survive on its own?
I think it's the latter. His argument is that you can't successfully split a company until the underlying business is on a glide path of growth.
Right. If you split a broken company, you just end up with 2 broken companies.
You expose the rot, and the bad coup might actually collapse without the support from the global arm. It's the fix the roof before you sell the house logic.
Makes sense.
But he also mentioned that market conditions have worsened. Consumer sentiment is down, geopolitical volatility. It's just a terrible time to do a complex financial move like that.
So he's pivoting to stabilize before you optimize.
Exactly.
Okay, let's talk about stabilization. He's not just asking for patience, he's asking for a lot of money. A $600 million incremental investment for 2026.
That's the headline number. And when you see where it's going, it tells you everything about what was wrong before. Half goes to price, product, and packaging. The other half to SG&A sales, R&D, and marketing.
The R&D numbers stood out to me, a 20% increase over 2025. That feels like an admission of guilt. Like, oops, we forgot to invent anything new for 10 years.
It's absolutely an admission. I mean, the new leadership was surprisingly candid. They said they have historically underinvested in their brands. Think about it. When was the last time you saw a truly new product from Kraft that wasn't just a new flavor of something old?
I can't think of one. It's just new shapes of mac and cheese.
Exactly. When you stop spending on R&D and marketing, which they're now boosting to 5.5% of sales, you just lose relevance. You become a legacy act.
So they need to contemporize the portfolio. I love that word.
It's corporate for make us cool enough that people stop buying the generic version.
All right, so what does $600 million actually buy us in the grocery aisle? What are these contemporized products?
They broke it down into 3 pillars: nutrition, convenience, and new occasions. And the one getting all the buzz is Power Mac.
Power Mac. It sounds like a laptop from 2005.
It does. But it's Kraft mac and cheese, launching in Q2 with 17 grams of protein and 6 grams of fiber.
Okay, hold on. 17 grams is legitimate. That's like competitive with a protein bar.
It is, and that's the entire point. We are living in a protein-obsessed era. People want functional food. And yeah, there are niche brands doing this. Goodles, Danza, but they're expensive. $4, $5 a box.
So Kraft is trying to use their scale to come in cheaper. Democratize the protein pasta trend.
That's the play. Healthy-ish mac and cheese for the masses. If they can convince a parent that serving this removes the guilt factor, it brings the brand back into the weekly rotation.
Okay, I see it. Then there's the convenience pillar. This one hit me right in the childhood. Capri Sun.
The pouch.
The pouch, which I haven't had since I was 10 because you can't bring a foil pouch to a meeting.
And that's exactly the problem they're solving. They're launching single-serve bottles for Capri Sun.
Finally.
And the insight here is huge. They believe this format is 60% incremental to the category.
Meaning they're not just stealing sales from their own pouches?
Right. They're targeting a whole new shopper, teens, adults, people in convenience stores. They want to be in the gas station cooler next to the Gatorade, not just the lunchbox aisle.
That makes so much sense. It's a whole new occasion. Pouches for lunch, bottle is for on the go.
Correct. And that brings us to the third pillar, which is expanding Heinz. They're doing the Heinz Simply platform with natural ingredients, which, is table stakes now.
Sure.
But the interesting move is what they're calling modern condiments, launching in Europe and Canada.
Modern condiments.
Think sauces specifically designed for chicken and fish.
Ah, because right now, Heinz owns the burger and the hot dog.
Exactly. But people are eating less red meat. If Heinz only lives on the burger, they miss out on the chicken dinner on Tuesday and the fish on Friday. They want to own the center of the plate for every meal.
This all sounds great. Protein pasta, adult juice boxes. But I have to go back to the money. The $600 million investment. Are they just going to pass that cost on to us?
This is where the strategy gets really risky, but also necessary. The CEO used a phrase that I think defines this entire pivot. Great consumer goods companies need to earn price.
Earn price? That sounds a lot like a mea culpa.
It is. He's basically admitting that for the last few years, they just took pricing to cover inflation. Their costs went up, so your price went up. They didn't earn it by making the product better.
And we all noticed. We traded down to the store brand because, frankly, it's 90% as good and 30% cheaper.
Precisely. So the new strategy is to provide actual value. They're introducing what they call opening price points. For example, a new 8-ounce salad dressing bottle.
So, shrinkflation.
Not exactly. Shrinkflation is when the package gets smaller but the price stays the same. This is introducing a smaller size at a lower entry price, say under $3. So a budget shopper doesn't have to commit to a $6 bottle.
Okay, that's a key difference.
But here's the real kicker. In some categories, they said they might actually lower the base price.
Lowering prices in 2026.
It shows you how desperate they are to stop the bleeding. They know they pushed the pricing lever too hard, and now they have to pull it back to regain volume.
It's a shift from inflation pricing to innovation competition.
That's the soundbite for the whole strategy.
But look, this is a massive ship to turn. Are there any signs that this fix-it strategy can actually work, or is this all just theory?
There are some green shoots. They pointed to their taste elevation platform, that's sauces, condiments, cream cheese. That part of the business went from losing share in the first half of 2025 to actually gaining share in Q4.
So when they focus, it responds.
Their response. Over 70% of brands in that platform are winning now. And even the problem children are showing signs of life. Lunchables consumption improved by 11 percentage points from H1 to Q4. Mayo improved 13 points.
So the brands aren't dead, they were just neglected.
That's the thesis.
Okay, so the patient is responding. But what's the prognosis for 2026? Because the guidance they gave, it wasn't exactly a party.
No, it was not. They are managing expectations very, very carefully. They're calling it a tale of two halves.
Which means the first half is going to be ugly.
Very ugly. For Q1, they expect a high teens decline in operating income. They're spending all that cash, the $600 million, but sales lift hasn't happened yet.
It's the expensive part of the renovation.
Exactly. And there was a specific headwind you mentioned from S&P benefits.
Yeah, we need to double click on that. It feels significant.
It's incredibly significant. They expect a 100 basis point impact on sales, just from changes in S&P, what we used to call food stamps.
Wait, 100 basis points, 1% of their entire sales volume just vanishes because of government benefit cuts.
Yes. And that tells you something profound about who their core customer is. When a cut in government aid immediately stops people from buying Kraft mac and cheese, it means your customer base is living on the razor's edge.
They're not competing with other premium brands for these shoppers. They're competing with not eating.
Or eating rice and beans.
Yeah.
It underscores why they can't just rely on brand loyalty. Loyalty doesn't pay the bills when you have $20 left for groceries.
Wow. So sales down, income down to start the year. What's the goal for the full year then?
The guidance is for organic net sales to be down 3.5% to 1.5%. So 2026 is a reset year, a rebuilding year.
It sounds like a sports team trading away its stars for draft picks. Trust the process.
That's a great analogy. The goal is to restore what they call a virtuous cycle. Better products lead to volume growth, which funds more investment. Right now, they're stuck in a vicious cycle of cutting costs, lowering quality, and losing customers.
They're trying to reverse the wheel.
A heavy lift.
So, to recap for everyone listening, Kraft Heinz is betting the farm. They've stopped the breakup, they're writing a massive check to fix the foundation, admitting they haven't earned their price tag, and they're trying to win us back with protein pasta and adult juice bottles.
That's the summary. It's a shift from financial engineering back to, actual food engineering.
Which honestly is what a food company should be doing.
You'd think so.
So here's the thought I want to leave you with today. We talked about the numbers and the strategy, but think about your own shopping habits. You've probably traded down in the last few years, bought the generic cheese, the store brand ketchup. Kraft Heinz is betting $600 million that they can change your mind.
And the question isn't whether they can make a better product. They have the labs. They can do it. The question is whether they can overcome the inertia of the modern, price-sensitive shopper. Can you unbreak a habit that you yourself taught them?
We'll be watching the shelves in Q2 to see if Power Mac is a savior or just a new coat of paint on a crumbling house. Thanks for listening to The Deep Dive.
Goodbye, everyone.